Alright legends, this is going to be a quick video on IFVGs and how you can incorporate these to enhance your trading or just get a better understanding of price. This is by far the easiest model to learn and master because of how visually easy it is to identify IFVGs. So here's the sequence. First you have a fair value gap, then you have a sweep of liquidity, and then you have an inversion fair value gap which inverses this fair value gap, so to speak, and the body of the second fair value gap that comes after is overlapping with the body of the first fair value gap. So fair value gap, liquidity sweep, and then overlapping fair value gap, right? Extremely easy. So some examples here. This is one example going from a higher time frame to a lower time frame for you to see how it forms, right? Sweep of liquidity, second fair value gap overlapping the first fair value gap. That's on the 1 hour chart. A 15-minute chart, you see legs of uninterrupted price action in between. That's how you can train your eyes to see if an IFVG is being formed at a higher time frame. Similarly here, this is not uninterrupted price action but with one bullish candle here, but by and large it is a inversion fair value gap setup. And this one goes from a lower time frame to a higher time frame. So this is on gold's December contract. So 1 minute chart, two fair value gaps, secondary fair value gap overlapping after a liquidity sweep. So on the 1 minute chart, this is what it looks like. You can see here there's another inversion fair value gap, right? On the 5 minute chart, it looks a little less clean. And on the 15-minute chart or anything above that, it looks like two candles wherein the first candle is huge and the second candle lies within the body of the first candle, right? So another example on currencies here. On this daily chart, price is very bullish. So the liquidity sweep is the sweep of internal range liquidity and then moving towards external range liquidity, right? Similarly, this is the 4 hour chart. Again, you see uninterrupted price legs right here and then right here. And then on the 1 hour chart, it's not as clean as we would like it to be, but at the same time, it's still an inversion fair value gap set up. So now, where will price go to, right? So in this case, in all these examples, you see that yes, this is a bullish reaction. So where is it going to go to? So it is going to go to the next draw on liquidity, and the draws on liquidity are of two types, right? There's so many more, but by and large, these are the two categories of draws on liquidity. So these can be day highs or lows, weekly highs or lows, equal highs or lows. When I say equal, I mean relatively equal. They don't have to be equal to the tick, but they have to be within the same area, within 10 points or 5 points, so to speak. Session highs and lows, London session highs and lows, Asian session highs and lows. So this is one of the most prevalent strategies, sweep of London high or low, and then a move towards the other side, right? So these would be order based, where people are resting their stop losses, buy stops, sell stops, whatever, right? And the second is inefficiency based liquidity. So these can be fair value gaps, volume imbalances, and opening gaps, new day opening gaps and new week opening gaps. I'm sure you must have heard this saying that gaps love to get filled or gaps tend to get filled or whatever. That's because they're a very powerful draw on liquidity. All right, so two high-level examples on the gold chart again, 5 and 15-minute chart, 23rd to 27th of October. So in the first example on the left, we have a 5-minute bullish inversion fair value gap. Bearish push to the downside, take out a swing low, and then a bullish push upwards. We come back and visit this price once. This is the optimal trade entry, but that's for later. Then pushes up, takes out a swing high, taps a fair value gap. That's two objectives at once. And then probably on a lower time frame, 15-second chart or probably even the 5-second chart, there's a bearish inversion fair value gap set up here. And then price keeps moving downwards. So the purpose of this was to show you that every meaningful price swing will most definitely have an IFVG, right? So for example, here there's most definitely an IFVG. This right here is an IFVG. This is an IFVG. Here was another IFVG. It's just a matter of which time frame that appears in and how you can capitalize off of that. So in the second example here, I've marked some volume imbalances on top and a 1 minute volume imbalance at the bottom, just to show you what volume imbalances are and how you can, work your way around them. So we move away. The beginning of this move is moving away from a bearish fair value gap. That means we're bearish. We came back to touch this and then we can go on our way down, right? So move away from a bearish fair value gap, create a bullish fair value gap and then a bearish fair value gap to inverse that to create an inversion fair value gap. Keep moving downwards to the tick, touch the 1 minute volume imbalance. You see this whole uninterrupted price leg. This was the motive. Play around for a bit, take out this intermediate term low, create an IFVG, move upwards, and in the process create another 15-minute IFVG, right? So once an IFVG is done, you can probably zoom out and see if that's still working on the higher time frame. And if it's not, it's a very valid short-term swing, which you probably cannot hold for the higher time frame depending on whatever chart you're looking at, right? So 15-minute inversion fair value gap, move upwards, touch both of these. Well, not quite touching the one at the top, but touch this 1 minute volume imbalance and then go lower. What does that mean? That means we are probably in a range right now because we are bearish. We created this bearish fair value gap, moved away, swept liquidity, came back here to fix the motive, grab some liquidity and keep moving downwards, right? Because this bearish fair value gap is still being respected, right? So all right, so this is today's Nasdaq chart, and I had an example from this morning to show you. So market opens right here, 9:30 a.m. bullish fair value gap, nothing to the left. So this is uncharted territory, right? So you want to be careful while taking any setups in uncharted territory, all-time highs, right? So we create this inversion fair value gap. What is the most logical place for it to go? These lows. And I'm not just saying this because it has happened already. This would have been the first option, or the second option would be anywhere inside this fair value gap. And if price blows through this, we're looking at either this or the next lows, right? Price is acting super funny because we're at all-time highs, so it doesn't really apply in the similar manner as it would on any other day. But for now, this will have to do. And if you have any questions, drop them below. And as always, enjoy life, legends. Enjoy life.